Hi traders, welcome to the Pitt Trades educational video series. In this series we've been talking about figuring risk. In video 1 we talked about why it's important to understand risk and reward and why you need it in your trading. We also talked about knowing your product. And we also gave you an example of what it means to hold your winners and cut your losers. And we showed that even on a 30% win ratio, we're able to make money with good risk-reward measures. Now, in the second video here, I want to talk about calculating risk size. Okay, this is the basis of your account, understanding how much you should risk in your account, because basically trading is your ability to stay alive and continue through the learning process and to build your account. Now, building your account comes with good risk-reward ratio, like I showed you in the first video. In other words, let your winners go, cut your losers short. But in this video, we're going to talk about how much can you risk per trade. Okay, well, we're going to give you an example here of a $50,000 account. That's a modest size account when starting to trade. And the rule of thumb in trading is risk no more than 2% of your account on each trade. I believe that if you're risking more than that, it's crazy for one and considered gambling, and more likely than not you have not a large enough account to be trading with. So in this case, we'll use a $50,000 account. We'll be using the E-mini S&P for the example as well. So $50,000 times 2% equals $1,000. Okay, so we understand that we can risk $1,000 on each trade. Now, if you want to reduce that and make it 500 or 1%, that's fine. This is just an example. So what I've done here is I've broken this down and showed you what it looks like. In other words, you have choices. Okay, so if we were going to trade one contract, okay, and we're trying to figure out what our stops would need to be. In other words, when you're looking at risk reward ratio, we need to know what our risk is before and our reward. In the first video we showed you a 3-to-1, and we showed that 3-to-1 risk reward ratio worked really well on a system that was only winning 30% of the time. Well, in this case, let's look at this. We have one contract. You were able to have a 20-point stop. Wow, on a because that would equal $1,000, and so you could actually have a 20-point stop on a one contract basis. Not what I would call very wise, because you're basically taking 20 points to make 60 points, and not a lot of people are able to hold their trades for 60 points without least scaling, of course. Another way to break it down is 3 contracts. That would mean your stops would be at 6 points and your risk would be $900, just less than the 2%. If you increased your contracts to 6, then you could have a 3-point stop, $900, again just less than 2%. Of course, 8, you could have a 2.5-point stop, and again $1,000 at risk right there. So you can have multiple different opportunities for understanding or calculating your risk. In other words, understanding how much you can use to trade off of. Now, you could use this in a variety of different ways. Let's say you're a 6-contract trader and it's becoming very volatile. Okay, the markets are swinging quite violently that we've seen recently. You could cut your contracts in half and then widen your stops. So you could go down to 3 contracts and widen your stops to 6 points. Or you could go down even further to 2 contracts. You'd have to do the calculations on that, but it all works the same. I would not be trading your full boat at 8 at 2.5 points when the market's swinging 5 points every turn. You're just going to get stopped out. You're going to get ground into the dirt, and your account's going to suffer for it. So understand how to calculate what your stops can be based on your account size. Okay, now if you understand what your sizing is and how you can size into it, and you go ahead and use the risk reward that we talked about in the past, in other words, letting your winners run and cutting your losers short, now you can grasp a hold of what it is to really risk manage your account and your trades and stuff. Include risk management into your trade plan, and if you don't have a trade plan, just buzz on over to pittrades.com. We have some example videos of how to develop a trade plan on there. And of course, if you're there, you might as well register for our free trial on our website, pittrades.com, and also our free newsletter. On the free trial, you'll get some great swing plans and stuff. I really hope this has helped understanding risk, and I hope you put this in your plan and put it to work, and I hope to see you down the road as well. Take care.